A long position is when you buy a stock expecting the price to move upward so you can make a profit from the increase in value. For example, if you buy a stock at $10 per share and it later rises to $15, you make a $5 profit per share. In this example, we're looking at the Upwork stock chart. You notice price reacting around a strong support level that has been respected multiple times before. The market is also creating higher highs and higher lows, confirming an overall bullish trend. There is a trend line acting as support, creating confluence between multiple technical factors. As price touches the area, a long wick candle forms, showing rejection from the downside and possible buying pressure entering the market. Because of these confirmations, you decide to enter a long position at around $10 per share. You plan to invest $500, so dividing $500 by $10 means you can buy 50 shares. After entering the trade, price begins moving upward. As the stock rises, you notice a previous swing high acting as resistance. A long wick candle also forms near this area, suggesting momentum may be slowing down. Because of this, you decide to close the trade and take profit at around $14.80 per share. Since you own 50 shares, multiplying 50 by $14.80 gives you $740. After subtracting your original $500 investment, your total profit is $240. Now let's talk about short positions. A short position is when you sell a stock expecting the price to move downward. To short a stock, you borrow shares from your broker, sell them on the market, and later buy them back at a lower price. For example, if you sell a borrowed share at $10 and later buy it back at $5, you keep the $5 difference as profit. In this example, we're looking at the Funko stock chart. You identify a resistance level and supply zone near a previous swing high. As price moves into the area, bearish divergence begins to form, signaling weakening momentum. You also notice a rising wedge pattern. Once price breaks below the pattern and creates a lower low, you believe the market may continue downward. You decide to enter a short position at around $11.80 per share using $1,000. Dividing $1,000 by $11.80 gives you approximately 84 shares. You borrow and sell 84 shares on the market, receiving approximately $991.20 from the sale. Price then continues moving downward until it reaches a support level and demand zone. Because of this, you decide to close the short position at around $7.30 per share. Buying back 84 shares at $7.30 costs approximately $613.20. To calculate profit, you subtract $613.20 from the $991.20 received from the initial sale. This leaves you with a total profit of $378. These examples demonstrate the two main ways traders make money in the market: buying low and selling high through long positions, or selling high and buying low through short positions. Successful trading is not only about finding good entries, it also requires discipline, patience, and proper risk management over time.